It's chapter 1 of advanced tax, and some of this is going to be a reminder. As in this whole course, we have a lot of reminders about how tax works because we still have to know everything we learned in the first tax class. So we're just going to be touching on some things and giving you a perspective. And in advanced tax, it'll be a little broader, but it is basically the same structure. So if you know what happened in the first tax class, a lot of this will be a breeze. If you just learned it for the moment, it's going to be a little bit bigger challenge because you just have to bring it back, but it's no big deal. All right, so starting off, as I like to do, ethical behavior for accountants is very critical. And so there's those 3 levels. And if you've been in my class before, I'm sure you've heard this. But the 3 levels of deterrence for doing something that you know is wrong. There's that individual character, and that is the most critical piece that keeps you from doing something wrong, keeps you on the straight and narrow ethically. And that is just knowing that something is wrong, so we don't do it. And so then the second level, which is not quite as strong as your individual commitment to integrity, but it is pretty effective for most people, is the firm culture. And that is when you work for some company, the action that you would consider might ruin your reputation or get you fired, and because the company has a policy or the firm has a policy that they don't entertain these integrity problems, and so they would automatically blackball you if they caught you doing something you knew was wrong. And then the third one that seems like the most effective of all the deterrents to doing something that is ethically wrong, it's actually the weakest, and that is the laws and enforcement. The prospect of going to jail or being prosecuted is the one that most people, just without, if you don't consider it very deeply, you think of that as being the biggest threat that would stop someone from doing something wrong. But it's not. And the reason it's not is that so many people can do something that's wrong and never get caught. And so, and also it kind of creeps on you if you have a situation where you're asking to compromise your standards. It could be something very small and insignificant, and then next time it's just a little bit bigger issue, and then before you know it, it becomes a big issue. And then you're kind of, if you compromise on small issues, it makes you more vulnerable because you're afraid of being exposed on the small issues. So it's more temptation to agree to compromise on a larger issue. So the best thing to do is always hold your standards by your own individual integrity and keep those standards strong. Draw a line in the sand. This is, I will not go where I know is wrong, and hold that line. And so you could also apply that to education, in that the same thing about academic cheating. It could be applied exactly the same way as these scenarios with professionalism. And so basically it's just a matter of, if it's not okay and you know it's not okay, just hold the line. Even if you would be helping someone else to do otherwise, you have to do what you know is right in order to be holding your integrity. Okay. So anyway, there's my little spiel, and I need it to make sure you understand it. Chapter 1, we talk about tax and what does it mean? So they've got someone got this great definition, which I just have to hold on to because I like it so much. And that is that a tax is an involuntary contribution required by law to finance the functions of government. So the operative word being involuntary, of course. So that's why you see so many people thinking, I don't want to pay this tax. I hate to pay tax. I'll do anything to reduce my taxes. And honestly, over the years, I've seen a lot of clients who would honestly do anything to get rid of their tax, even as far as throwing their money down a black hole in order to avoid paying tax on it. So I would recommend that you keep in perspective that government does not take all of your money when they tax you. So you would never want to invest in something that was going to make you lose the value of the investment in order to get a tax deduction, because that would be giving away 100% of it. And so I really would like to make sure you understand that. So when your client tries to talk about investing in this certain thing that could be very risky as a tax deduction, you need to keep in perspective that they're only paying a portion of each dollar in tax. Whereas if they invest in something that's never to be seen again, they're paying the entire amount of that to it's gone. But in any case, so I've definitely seen some people that would like to do that kind of thing over the years. But anyway, then the next topic is the tax base. And that's why we do what we do. We are trying to come up with what the taxable income is, because we need to know what to assess the tax on. So you'll see in the textbook on page 115, they talks about the tax formula. They talk about the tax formula, and I have captured it here on the screen. Now you'll see that the tax formula starts with income that's broadly conceived. That means everything you get, whether it's taxable or non-taxable. And then some things are specifically excluded from taxation. And once you reduce from your total broadly conceived income by that exclusion amount, then you're down to, this is the gross income. So if I had no deductions, this would be my taxable income. But most people have some deductions. And so if you have deductions for AGI, meaning deductions you can take before the calculated amount of adjusted gross income, then those are called above the line deductions. And then once you've reduced by your gross income by those above the line deductions, you come to the number of adjusted gross income. A lot of people refer to their AGI as what their income is. And then they deduct from that other expenses that are deductible, like itemized deductions, or if you don't have enough to itemize, or if the standard deduction exceeds your itemized, in other words, then you would take the standard deduction. So there's only two types of expenses at this time that are reducing AGI to bring you to taxable income, and that is your alternative of either itemized deductions or standard deductions, and the QBI, or qualified business income. Now that situation is only with us temporarily. So assuming no law change, then those two things are the only thing deductible to get to taxable from AGI through the year 2025. And that is because at the end of 2025, barring any kind of extension or change in the law, those will change, and there will no longer be a QBI deduction, but the personal exemptions that we used to be able to deduct for yourself, your spouse, and your qualified dependents would come back at that point. So once you lose QBI, you're going to regain the personal exemptions and the dependency exemptions if law does not change. And so that would bring us, as it stands now and up until the end of 25, that's how you calculate taxable income. Once you know taxable income, then you calculate it based on the tax tables. And in the first tax class, we already learned how to do that. We'll do a refresher in this class, and I'll post a video about it, about how to calculate those based on the tax tables. But you take your taxable income, calculate the tax based on those rates and your filing status. And so you could be, the filing status, as you know, is you could be single, head of household, married filing separate, married filing joint, and then qualifying widower, which is still married filing joint status. But in any case, those statuses and your taxable income allow you to use the table to see how much tax you owe. And so once you calculate the tax, the federal tax, then you would reduce that by any tax credits or amounts you had prepaid, like withholding or estimates. And that brings you to the amount that's either due to the IRS or it's a refund due from them to you. All right, so there's 4 kinds of tax rates as far as how they operate. So progressive tax rates become higher as your tax base increases. So this is the one that most people think of as a fair way to calculate tax based on the fact that some people have more resources than others, some people have more income than others. So as your income increases on progressive taxes, you have a higher percentage rate. And so the federal income tax is like this, the gift tax is like this, the death tax or estate tax is like that, and most state income taxes are also like that. So if a state assesses a across the board tax rate, one rate, then that is not progressive. And just like currently the corporate income tax is not a progressive tax because it is across the board 21%, which means as of the year 2023. And so that means that they're not progressive. It's a standard proportional rate. And so getting to the second one, Proportional is when the rate of tax remains constant for any given income level. So the corporate income tax I just mentioned is currently at that position, and also sales tax often are like that, like most excise taxes actually, which includes sales tax and employment taxes. Most employment taxes are proportional, meaning they continue across, like Social Security, the FICA tax component of it. And then, but if your income level is a certain level, once you get to a certain level, they stop collecting the Social Security tax. So some people say because of that, the Social Security FICA tax and the Medicare tax are not totally proportional. And so they could be considered a form of regressive tax. And so that brings us to the third one. The regressive tax is when there's a lower tax rate applied when the tax base increases. So once you go over the FICA tax base, you don't have to pay FICA tax anymore. So that piece of it is regressive. That's at that level where your income is above the base. So that's just kind of an overview of what the different terms mean. Progressive is the most common that we would use in income tax, because as your income goes up, so does your tax rate. All right, so then there's ways that you can express the tax. So there's the statutory rate, which is just the what the IRS assesses each level of income at under the progressive system. And so we'll do some exercises about this. And then the marginal rate is the rate that any additional income comes in at. So your marginal rate is if you earn some more money, how much am I going to have to pay? What percentage? So that is like based on the table, that's where your taxable income lands. When you look at the table, that rate that you're being assessed for that bracket, that is your marginal rate. Marginal bracket is another term they use. And then the average rate is just tax liability divided by taxable income. Effective rate is tax liability divided by AGI. Usually, it usually would say, if it's some other base besides AGI, it would say that. But effective rate generally is considered tax liability divided by AGI. So they sometimes say effective rate based on AGI. All right, and then there's some major taxes on individuals and business entities. Just reminding you, transaction taxes includes the excise taxes like gasoline tax, cigarette tax, alcohol tax, motel tax. Some people call those sin taxes. That's just a term that kind of got attached to them years ago. And then sales and use tax, usually only state and local governments, but not all of the state and local governments assess sales tax. And then there's severance tax here in Louisiana. We see this a lot. We get a lot of income from it because we have the oil and gas. But then there's custom duties like tariffs. These are all transaction taxes. Franchise taxes. Louisiana does have a franchise tax. They tax assets, sales. The right to do business is how franchise tax is assessed. And most, well, I don't know if it's most, a lot of states assess a franchise tax on their companies, sometimes just corporations, sometimes both individual and corporations and partnerships. But in any case, it's usually for the right to do business. Occupational license and taxes, similarly for the right to do business, it's fees and permits. Those are all transaction taxes. Then you have valuation and wealth taxes. This also known as transfer taxes, property taxes, wealth taxes. And so federal estate taxes tax the property and it's transferred from a decedent to their heirs. And it's based on the value at the date of death or 6 months later. You could choose. This is also known as the death tax. And then expenses can be deducted for funeral, administration, charitables, a marital deduction, which means if you leave it all to your spouse, and several other items can reduce the amount, the estate tax. And then once the tax is determined, you get a credit that eliminates the tax for most estates. And for year 2023, the amount you could have that is actually to be taxed, but exempt because of this credit is $12.92 million per person. And so that's why most people don't pay estate tax. But there are a lot of cases where the individual owns assets of more than 12.92 million, especially if they have a business or a lot of property. But in any case, that definitely is something you see even here in Louisiana, in small town Louisiana, Monroe, Bastrop, all these places near where we live, that is quite possible for there to be taxable estates. And then state inheritance tax taxes the property as it's received by the heirs, and not all states have this. Very few have it actually, but some states do tax the heirs as they receive these inherited assets. And then gift tax are similar to estate taxes, but they are given while the gifter is alive instead of at their death. And so it's also an excise tax or a transaction tax in a way. It taxes the property that's transferred during a taxpayer's life. The gift amount is determined by the fair market value at the date of gift, whereas the estate tax was the fair market value at the date of death. And there's an annual exclusion that allows a taxpayer to gift to anyone they choose. It could be a relative, it could be a friend, anybody, as long as it is $17,000 or yet less for the year 2023. And it doesn't count against their annual or their lifetime exclusion of gifts and estate transfers. And so that annual exclusion is a method that a lot of people use to transfer assets to their heirs or their charity, whatever, any organization or person that they want to, without it ever using up their gift tax limitations. If it's a married couple that wants to give gifts, they can split the gift and give up to $34,000 in 2023 per couple. And if they're giving to a couple, it would double even then. 68,000 could be given from one couple to another couple in a year without having to file any kind of report or having to use up any of the annual exclusion. And then once you determine what the gift is, if you have a huge gift you give in 1 year, you would be allowed to eliminate that as long as during your lifetime you didn't transfer more than 12.92 million. So again, it's the same amount. It's not two different sets of 12.92 million. It's just that one time lifetime limit of gifts and estate transfers that you can give without having to pay estate tax on them, or without having to pay transfer taxes, I should say. And then property taxes are another form of valuation tax, and it's an ad valorem tax administered by the state and or by the local governments based on the value of the property. It can be taxed. Property tax can be on real estate, which is known as realty, real estate, and the improvements of the land that are integrated into the real estate. In other words, they're permanently attached. And then the second kind of property tax can be assessed is personalty. And this doesn't mean it's a personal asset necessarily. It could be business or personal, but it just means it's not real estate and it's not realty. So if it's not permanently attached to the land, then it would be considered personalty. And of course, if it's jewelry or something like that, that would still be personalty. And then those two kinds, transaction taxes, valuation and wealth taxes. And then the third one is, of course, the income taxes, which is what we're doing in this course. And so individuals have a pay-as-you-go system for federal and for state. It includes withholding and estimated tax payments to cover the tax so that it is paid by the day that it's due. And then the federal and most states impose income taxes, but some local governments do also, and some states do not. But the states have different methods of assessing the tax. So some have a sophisticated system of their own that has lots of details, almost as comprehensive as the federal. And that would be like Arkansas with their base that's not piggybacking from the Fed, and then Louisiana, on the other hand, that is a piggyback state that starts with the Fed and makes adjustments from there. And so this Arkansas system is much more complex because it has every detail lined out, and it's different from the federal in many cases. Then corporations that also have a pay-as-you-go system for Fed and states, and most states, and if not all, and that is estimated tax payments, since there's not withholding on corporate earnings. And then Fed and most states impose corporate income tax. But there's also the franchise tax that's usually integrated with the income tax on the reporting forms. But this course doesn't cover a lot of corporation tax, but we do hit it at the end, or no, somewhere in the middle of the course, I should say. But we do like try to learn the nuances that are different, because when you deal with business, mostly it's the same for individuals and corporations. But then there's the taxation angle once you get down to taxable income, about how it's distributed and how it's taxed. And those are what we'll be picking up on, is those differences in different organizational structures, whether it's individuals, corporations, partnerships, S corps, in LLCs, different formation types. And then another kind of taxes is the employment taxes, and that includes FICA, which is Social Security and Medicare, and also FUTA, which is the federal unemployment tax, plus the SUTA, which is the state unemployment tax. So unemployment and ordinary payroll cost of tax. And so the Social Security tax is a 6.2 tax on the first 147,000 in 2022, and then in 2023 it is the first 160,200. The Medicare is 1.45% on all wages. That's how much is withheld, and that's from the employee, and that's how much is charged to the employer. And then there's an extra 0.9% that the employer does not have to match on wages in excess of 200,000 for single, or 250,000 for married, filing joint. Self-employed people pay both half of the Social Security and Medicare, so they double the amount of those rates that we just discussed. And then they pay also just the 1.9%. And then this percentage is right here, not right. See that 10.4 is supposed to be 12.4, 6.2 twice. Okay, and then FUTA and SUTA, they're paid by the employer. The FUTA tax is 0.6 of the first $7,000, but it could be higher if there's no SUTA tax. So most states charge a state unemployment tax, but if they don't, the feds would charge the difference up to 6%. So 0.6% is what Louisiana employers pay for federal unemployment, because we have a robust SUTA tax system. But some states, they would pay a higher FUTA tax because they don't have a SUTA tax. All right, and then that's just giving you a little experience. We're not really delving into employment taxes at all. Okay, and then there's income taxation of business entities, and two kinds that we'll talk about are tax at the entity level, and that's proprietorships, because they pay on their personal return, and C corps, which pay on a Form 1120. Then there's non-taxed entity at the entity level, but still producing taxable income. So it's called a pass-through or a flow-through, sometimes referred to as a conduit unit, and that's partnerships, S corps, and LLCs. So they would each report the income on their respective tax form, but then it would flow out as taxable to the owners on a Schedule K-1. So what they'd have is the Form 1065 for a partnership would include a Form K that included the total of all that's being distributed out as taxable to their partners. And each partner would get a Form K-1, and they would show their part of how much should be reported as income, deductions, credits, any of those things. So the partnership determines how much is taxable and then shares just a piece of it with each shareholder, or each partner, I should say. Same thing with S corps, they're just not partners, they're shareholders. And then LLC and LLP members, those are considered partners, but they report it either on a 1065, or if it's a one-member LLC, it would be shown as in a proprietorship. And then there's some information in this chapter about tax planning, and I always think tax planning is worth your effort, but it's just not something that's easy to test. So I very seldom, if ever, test on tax planning, but I do this unit. There will be some testing on it, in that knowing the difference between tax avoidance, which is just good tax planning, and tax evasion. So I need you to know what the difference is, because tax avoidance, good tax planning, is legal and fine and actually necessary. And then tax evasion is illegal and it's fraudulent, and we definitely want to avoid it at all costs. So tax avoidance just means trying to lower your tax under every legitimate means. And so that means avoiding recognizing income. In other words, structure the activity where it's non-taxable if possible. And then defer recognizing income, delay it, in other words, or accelerate your deductions so that they come in earlier if it's legitimate to do so. Then converting income reductions to more advantageous form. Like if you had ordinary income, you could convert it into capital gain by changing the way it's invested. And then choosing a business entity with whatever tax attributes that you wanted. The taxability of the different entities, as we just mentioned, makes a difference. And so you could use that entity choice to help you with your tax planning. And then preserving the formalities by keeping good records is always good. That helps you avoid extra tax and penalties that would arise if you didn't. And then you should always act in a manner consistent with your intended objectives, because that sometimes comes into play. What were the intentions of the parties whenever they did this transaction? So avoidance is just doing planning and minimizing your tax wherever legal. And then tax evasion, on the other hand, is willful deception or fraud and underpayment of the tax on purpose, and then affirmative action by the taxpayer to evade or to not pay tax. There's some good examples on page 123 in this Exhibit 1.3. And then let's see, last page of our notes, the objectives that drive federal tax law. Okay, number one. The federal government needs money, so revenue needs. The government has to operate, so tax laws, and whenever tax laws are formed, many times they try to make them revenue neutral in other words, if it's raising tax, then they're trying to lower tax somewhere else. But ultimately, they're raising tax if they need to raise money, of course. And then economic considerations is another one. This is to encourage certain behavior that seems good for the economy. This would be like giving you a deduction for depreciation, giving you credits for research, and giving small business tax credits because small businesses hire people. And so all these things are just trying to stimulate the economy through some tax incentive. Then social considerations. This encourages others to provide a benefit that the government would have to pay if you didn't do it yourself. And so it gives companies deductions for pension plans and health insurance. It gives individuals and companies deductions for charitable contributions. Companies get deductions for dependent care that they provide for their employees. And the earned income credit is another way that the government encourages people to provide a benefit, meaning if you work, then you're going to get this credit so the government doesn't have to pay for your housing and food. So in other words, EIC, earned income credit, is designed to get people off of welfare rolls to some extent so that government doesn't have to fund their life. And that's because we're trying to encourage people to go to work. Okay, equity considerations. It's this fairness adjustments, avoiding double taxation, like corporations. Over the years, corporations would, and still do, pay tax. Then they make a distribution to their shareholder, a C corporation, and it's taxable again to the individual. And so that's double taxation. And so so that one has not been eliminated, but that's one of the equity considerations that comes into play when you're doing an entity choice. Because if you did an S corporation instead, you would not have that double taxation, for example. Okay, but some others are the foreign tax that you pay. You don't have to pay tax in the U.S. and in a foreign country when you earn income in another country. If you're a U.S. citizen, you can take a credit for the tax you paid to the other country. So that's just an equity, trying to balance it out where you're not paying double tax. And then a deduction for state tax. When you pay the state, you get a deduction on the federal if you itemize deductions. And then involuntary conversion is a policy where if you have a fire or a flood or something that destroys your property and you get insurance coverage for it, rather than making you pay tax on that, you can reinvest it into a similar property and not pay tax. That's an equity consideration that caused that law. Then compliance, this makes compliance, meaning making sure you're paying tax on all the income and not cheating. And so they have, because of that consideration, they have implemented a lot of interest and penalties on the amounts owed. If you don't file, if you do it erroneously, a lot of different penalty structures. And then political consideration, compromises and special interests, pet projects. This is, where the representative tries to get something for their own district or for a donor that helped them fund their election. There's a lot of reasons why, but there's a lot of special projects. And then the next thing is IRS influence causes tax law changes, and that for the ease of administration, or if they see some loophole that's being taken advantage of. So we have a lot of rules that are very complex that have arisen because of IRS influence. One is passive loss rules. It's complex. Imputed interest rules, another complex one. And then alternative minimum tax, extremely complex. And so all these are ways to try to make sure that people are paying their fair share and that are not evading tax or some similar objective. And that's all from the IRS alerting Congress to there being this problem in this area. And then a big reconciliation. Let's try to fix it, with a lot of trouble for accountants. But, not saying it's wrong. I'm just saying it's trouble. And then the court's influence. Court decisions can override congressional law. For example, the stock dividends are non-taxable, but they would have been taxable if the courts had not determined that they should not be. So that's just some of the general overviews of the objectives that drive tax law. And then that's all I have for chapter 1. We'll just leave it at that for today.